In our previous video, we looked at the characteristics that are necessary to have a perfectly competitive market, right? Large number of buyers and sellers, perfect information, no transaction costs, no barriers to entry or exit, homogeneous product. So now we're going to look at the impact that those pieces have on a perfectly competitive market. And to do so, let's look at our wheat market. And we're going to assume that there's no wheat board. So we have individuals competing to buy and we have individuals competing to sell. Okay. All right. So here's the demand and supply for wheat. And that sets the market price. So we'll assume the market price here is $10 a bushel. Now, what if there is a change in preference? So what if there is a new diet fad? Maybe it's COVID and everyone is stuck at home and now everyone wants to buy their own flour and cook tons of bread. So what does that do in the market for wheat? So if there's a change in preference, does that change supply or demand for wheat? Well, if we're all going to stay home and bake lots of bread, then we're going to need more flour, which means we're going to need more flour made from wheat. So there's an increase in demand, right? So that increase in demand does what to the market price of wheat? So let's look at our graph here, and we see that that increase in demand drives the market price up. And we'll assume the new market price is now $12. Okay, so let's look at the individual firm. This is your wheat farm, and these are your cost curves. So just as a quick review, which curve is which? All right, let's start with the one that's downward sloping. What is that one? Average fixed cost. Okay, then we have this U-shaped one here. What is that? That's average variable cost. And we know that average fixed cost plus average variable cost gives us average total cost. And we know the check mark shaped one is marginal cost. All right, so here's your company, your farm's cost curves. And based on that market supply and demand, the price is $12 a bushel. So the decision you have to make for your farm is at $12 a bushel. How many bushels are you willing to make and sell? Well, how do we figure that out? We know, because we're rational, we do things when the marginal benefit is more than the marginal cost. The marginal benefit is how much we gain. So we're going to sell it for $12 a bushel, and we look at the marginal cost as a comparison. We do things as long as the price is more than the marginal cost. We don't do things when the extra cost is more than the extra benefit. So where do we stop? We stop when they're equal, and price equals marginal cost. So we can look here and we can see, as a farm, how much are we willing to sell? Okay, well, at a price of $12, we're willing to sell, looks like about $3.75. Are we making profit? How do you know? Well, if we're producing 375 units, we're selling them at $12 a piece. It costs how much to make it? Well, here's our cost per unit. Here's the price we're selling it for. So we can see here the profit that we're making. So all of that is our profit, and we could calculate our profit. Oops. Remember, this is an approximation for economic profit. Economic profit includes both your implicit and explicit costs. Okay. And the profit we calculate here would be our $12 that we're selling it for minus, what does that say, $10.50-ish, which is the average total cost for our 375 units times our 375 units. So we can calculate our profit here. But we see that our farm is making profit. Okay, so then what happens? Well, other people see you making economic profit with your wheat farm, and what do? Well, they want to be wheat farmers too, because obviously you're making good profit off of it. So what happens then in our market? Well, if lots of sellers are joining in, because remember, there's no significant barriers to entry or exit, so it is not so costly to become a wheat farmer that it keeps people out. If other people join in as wheat farmers, what does that do to the market here? Well, we're changing the number of sellers. So what happens? Changes demand, changes supply. Well, number of sellers changes supply. So let's assume that tons of people join in. Huge increase in supply. Much bigger than that increase in demand. What will that do to the price in the market? Okay. Well, that increase in supply will push the price down, and I think I may have to put this bit more on my graph. So think about a big increase in supply, and hopefully on your graph you can draw it, but we see a much lower price. Maybe I'll just create a new one here. Demand, supply, increase in demand, big increase in supply. Okay, so we were here. That increase in demand drove the price up to $12. Now we're seeing a big increase in supply that's going to drive the price down. So let's assume the price is now $8 in the market. At $8 in the market, what happens to the businesses? So now at $8, again, we have to make a decision as to what we're going to do. How much are we willing and able to produce? We're still rational. We're still going to produce as long as the extra benefit's more than the extra cost, and not produce if the extra cost is more than the extra benefit. So when do we stop? We stop when price is equal to marginal cost. And that's going to determine how much we're willing and able to sell. So here it looks like it's $300. So all of these sellers coming in to produce wheat has pushed the price down. How has that impacted our individual farm? Are we making any profit? How do we know? Well, we look at a quantity of 300. What are we selling it for? That's the $8. And how much does it cost per unit to make it? So then we're going to our average total cost curve. And sorry, I put it a little bit above the line because, as I stated in a previous video, my graphs aren't super accurate. I had to draw these on the computer. The lowest point on the average total cost curve is always where it intersects the marginal cost curve, which means that the graph has to go up from there. So I'm just trying to denote that that point at 300 bushels is a higher average total cost than what we have labeled there as the intersection of the average total cost and marginal cost. So I beg your forgiveness for that. But this here is our loss. So here our farm is operating at a loss. No longer profit, now we're losing money. So what do? In the short term, we know that we have to continue operating even though we're at a loss. And we know this because this price of $8 is above what? It's above the shutdown price. And where's the shutdown price? Okay, so here's the shutdown price. And we operate at the price of $8 even though we're losing money, because if we simply stopped producing on our farm, we would still have fixed costs we would have to pay out of pocket. So as long as we can cover the cost of labor, which we know from the average variable cost curve, then we continue to operate. So any price above the shutdown price, even though it's not profitable, allows us to take every extra penny and help pay down some of the fixed cost rather than having to eat it entirely out of pocket by just shutting down. So we continue operating in the short run at a loss. But what about in the long run? What does it mean to be in the long run? In the long run, do you have fixed costs? No. Given enough time, your leases end, contracts get renewed. So there's a period of time in which all those fixed costs become variable. So in the long run, would you continue to operate at a loss? No. Get out, do something else. Remember, there's no significant barriers to entry or exit. So in the long run, if we're not making profit, we go do something else. So then what happens in the long run? In the long run, if we get out of the market when we're not making profit, what does that do to this graph here? Well, if there are less sellers, it's going to change what? Supply. And that decrease in supply is going to make the price go up. So then we look, is that new price profitable? In the short term, we live with that price, whatever it is. But in the long term, if that price is not profitable, then people get out. So where does the supply curve stop shifting back and forth? Where does the price end up in the long run? Well, let's go back. If the price is up here, others see you making profit and they join in. So supply increases and the price goes down. If the price is low, like here, others see you or you are losing money. And in the long run, when those fixed costs are no longer fixed, you get out. So supply decreases and the price goes up. So if here the supply is going to increase, pushing the price down, and here supply is going to decrease, pushing the price up, when does the price stop moving around? It stops moving around when you end up here. Because remember, if the price was up here, people join in. If the price is down here, people get out. What is this price right here? This price is what? This is the break-even price. And what is this quantity that goes with the break-even price? What's that called? That's economic capacity. So in the long run, in a perfectly competitive market, the price is the break-even price. The quantity is economic capacity. In the long run, in a perfectly competitive market, do businesses make economic profit? Up here, economic profit. Down here, not so much. So there is no economic profit in the long run. Now remember, there is a distinction between economic profit and accounting profit. Economic profit means what? You're covering all of your expenses and you are compensated for the opportunity cost. In other words, when you're making economic profit, you're making more profit doing this than anything else. But in the long run, in a perfectly competitive market, because there are no barriers to entry or exit and people are coming in, pushing the price down, if you're losing money, you get out. In the long run, there's no economic profit. Because if you could have made more doing this, if you could have made more doing something else than this, you would have gotten out. And so it makes the price end up at that break even where there's no economic profit. You're not better off doing this than something else, but you're not worse off either. Okay? No no economic profit in this in the long run. So as a company, do you want to be in a perfectly competitive market? No. And that's why businesses differentiate themselves. That's why you'd rather be in a monopolistic competition than in a perfect competition. Because if you can be different from the competition, you gain market power, you gain economic profit in the long run. You aren't subject to this where other people come in and customers are buying from whomever is the cheapest. You want brand loyalty. You want them to buy from you so that you can make economic profit. More doing this than the next best alternative. From an economic perspective, we like perfectly competitive markets. Society likes perfectly competitive markets. Now, businesses don't want to be them, but society likes them. And the reason that we like perfectly competitive markets is because where are we on the average total cost curve? We're here, where it intersects marginal cost. We're at the minimum average total cost. So the reason that society likes perfectly competitive markets is it pushes the per unit cost as low as it can go, which means this business is operating at its most efficient. It's productively efficient. That average total cost is at its minimum. So what we've shown here is that if you have a perfectly competitive market, lots of buyers and sellers, no preference, right? Because perfect information, homogeneous product, and no transaction costs, then people buy from whomever is the cheapest. And if there are no significant barriers to entry, so people can come in and out in the long run, because in the fixed short run, you have fixed costs, you have to consider those. But if we have all those characteristics, then what that leads us to is a market where the price in the long run is at the break-even price, the quantity is at economic capacity, so the business is the most efficient, and there's no economic profit. We're going to compare this scenario to what happens if you can differentiate your product. So if you can be a monopolistic competition and be a little different, we can use these same cost curves and graphs to show what will happen and why that might be preferable to the business and maybe less preferable from a society experience in terms of efficiency and higher prices. So we'll look at monopolistic and we'll look at monopolies in the coming videos.